If you own stocks that pay dividends, you have likely heard of the ex-dividend date. Here is exactly how it affects your payout. The term ex-dividend simply means without dividend. It is a critical cutoff point for determining who receives the next scheduled payment. To be eligible for a dividend, you must own the stock at least one business day before the ex-dividend date. Tracking these 4 dates helps you understand the life cycle of a dividend payment from announcement to the final transfer of funds. If you buy on or after the ex-dividend date, the previous owner still gets the payment, and the stock price usually adjusts downward. When a dividend is paid, the company assets decrease, so the stock price typically drops by roughly the dividend amount on the ex-date. Remember that you cannot simply buy a stock just before the ex-date to profit, as the market price accounts for that dividend payout. Understanding these dates helps you manage your portfolio timing. Check back for more basics on how markets work. Thanks for watching.